Starting. So 3, 2, 1. Alrighty, we are live. Okay, well, hello all and welcome back to another episode of Paris and Baz Cast, where we discuss all things real estate and finance and what's affecting the industry. Today we have Kim Quach from Duotax Quantity Surveyors joining us to talk about the pros and cons of an investment property. That if it's a brand new purchase or an established property, what are the benefits? What are the shortfalls for those kind of purchases? So let's talk. Hello, Quinn. How are you?
Good, Anmol. Thanks so much for having me on.
No worries. It's been a while since we caught up last time. I think this was the first series is when we had you on our podcast. So welcome back.
Thank you. Thank you. Always a pleasure.
Absolutely. So if I could just get you to start off with a bit of background about yourself, what Duotax does, and then we'll get right into it.
Yes. So, Anmol, I'm Kim. I'm one of the BDMs here at Duotax Quantity Surveyors, and basically, a quantity surveyor. We're a national company that prepares what's called or specializes in what's called a tax depreciation schedule. So fundamentally, these reports are used by property investors. And it outlines an investment property's physical wear and tear each financial year. And basically, the figures that we provide each and every financial year is used by the accountants to claim as another form of tax savings. So it's another way of offsetting your taxable income. And it lasts for 40 years on most cases too. So,
yeah. Absolutely. And the interesting thing is, I've noticed not every landlord gets one, which is, they're leaving money on the table when they're going for these things. So it's bizarre. So let's talk about the quick as a cost of that and what the report entails and how long it lasts for as well.
Yeah. So reports generally will last 40 years from their build date, or it would be 40 years from the most substantial renovation date. So technically, these reports can cost anywhere from $500 to $700, dependable on the locations of the properties as well. Yeah. And this fee is also a tax deduction too.
Oh, there you go. So you are, getting that as a tax deduction, and then thousands of dollars, depending on what the renovation or the amount is, or the actual purchase amount is, that you can depreciate over the life of the property, 40 years. And as we were discussing offline, majority of that does happen in the first 7 years, as you mentioned. So the big lump sum does happen in the first 7 years, and then it sort of reduces from there. So for those investors that are buying brand new property, it makes sense for you to hold on to it for at least 7 years to be able to get that the majority of the benefit, and then the capital appreciation will look after itself in terms of returns for future as well. So now, currently, if you've been following our social as well, you've seen there is a huge shortage of properties, and that brand new or already established as well. People are spending all sorts of dollars on rental properties to be able to secure a property. We've had change in the skilled migration. So lots of families have come from overseas for work purposes in Australia, which is, are being met with such low vacancy rates. We're less than 1%, I believe, where there's not enough availability of stock. So one of the key messaging that we are telling anyone that is willing and able and ready to go is to buy a property. And when you are at that consideration set, the main question that we get asked is, should I be going for a brand new one, a unit, for example, strata property, or should I be going for an established property that has had a bit of wear and tear, but is in a better location and so on? Let's talk about those things at the moment.
Yes. Yeah, so very good point, Anmol. And I think also when people move overseas to, be with their family, they generally want to be around or close by to where they live as well. So I think very important is I have a case study to outline. So let's say Baulkham Hills area, right? Land is now starting to get quite scarce in Baulkham Hills, or a lot, I should say, to be able to buy a brand new home. So brand new homes, and you would know, roughly say 4-bedroom, double story, about 2.8 at the moment, brand new.
Yeah,
brand new. Yep. Yeah, versus let's say if you bought an existing property, maybe 20 years old, 15 years old, still 4-bedroom, 2-story for about 1.5 mil.
Yeah.
So you can see already, I guess, not only in a lending perspective, but also in having to save a deposit or have that cash for a deposit available of like what of that extra um, would sometimes be not even achievable for many people. So yeah, so that's like 1.3 mil already.
Yeah, yeah, exactly. The difference. Yeah.
Difference, yeah. So one of the pros I think, especially with buying existing properties, is that think about that 1.3 mil that you're saving.
Mm.
That what could you do with the amount of money to actually renovate a $1.5 million, the $1.5 million home,
Mm.
and then actually renovate it to a stage where it could actually be very closely mimicking a brand new home.
Yeah.
And then the rental yield that you would get in it as well,
Yeah.
in consideration with the location that this existing home would be in as well.
Mm.
So that's something that many people are starting to look at, buying an existing property for a lower cost and then
Yeah.
renovating it for a bit more of a premium price that they would normally renovate for.
Yeah, yeah, absolutely. In comparison to the amount spent, so say for example, you're spending, 150,000 on renovations versus, the purchase price. What exactly? How does that translate into the depreciation schedule?
Yeah, so 150,000, I guess, in depreciation works out to be almost building a brand new granny flat.
Mhm.
And so at the moment, granny flats are going for about $150,000. So
Yeah.
when you take that into consideration of a renovation in a home,
Mm.
it's so most cases it's so substantial that it basically resets all depreciation in that home. So the
Mm.
ATO will actually allow you to claim full depreciation once again if
Mm.
the home is substantially renovated. And that means like, refurbishing the whole home, knocking down a wall,
Mm.
making the kitchen and the living area open plan,
Yeah.
which is very popular at the moment too,
Mm.
or even extending the home outwards or upwards as well.
Mm. Mm.
So in terms of figures, it could be looking up into like the tens of thousands depreciation
Mm.
return for clients.
Yeah. And in terms of, for example, when it is a brand new property, like what are the things that go in a depreciation schedule? Obviously, the land part is separate. It is the construction cost.
Mm.
How do you get that? Do you rely upon what's been provided by the builder, like the cost of construction, or do you have a formula that you use to actually establish that? Because what I'm trying to get at is that if you're buying a brand new property for 2.8 and out of that 1.6 is just the land amount, the rest of it is the property value. Obviously, you're not going to spend 1.3 on renovations of a property to lease out. Some may, but more often than not, the renovations are not as extensive. So comparing a brand new of the amount that you would be able to get from a depreciation for a brand new property versus a property that you're spending that is already depreciated, like that's already old. You're buying it at land value and then adding value to it with renovation. What's the difference?
Yeah, so at the moment, construction pricing is quite significant.
Yes.
So if for a 2.8 mil two-story home, 4-bedroom house, you're probably looking at about $450,000 or $500,000 to
If not
potentially
more.
build, or yeah,
Yeah. Mm.
yeah.
Depending on finishing as well.
Where
You
yeah, and we're just talking the construction costs. We're not even
right.
talking about landscaping or
Yeah.
fencing or any of the additional features that you might want to install into your property.
Mm.
So all of those, when they take into account, we do use a builder's contract because as investors, obviously the price that people pay for an investment property would also have a premium on there as well, which is the builder's fee and charges, their wages and all of the contracts associated to finalize the property.
Mm.
They may also include all of the professional services costings too, which
Yeah.
is depreciable as well. So your surveyor fees, your certifier fees, architectural fees if you had to get a external architect to come in and draw the plans for the client. So all of those fees come into play. But if clients are buying a already just completed property from a builder or from a developer, then it's basically just that contract that they get provided at exchange.
Yeah. And then obviously in established property, you go out there to see the physical.
Yes.
What's the life expectancy of the remaining items and what can be depreciated, basically.
Oh yeah. So for existing, it's a little bit different. We need to go back in time, go back to when it was built, and then work out the BCI, so the building cost index of the actual year, and just measure up the plans and see, okay, so this 100 square meter home would have cost this much to build, and then we work backwards from there for that.
Yeah. So let's say purely on new versus established, what is better in from a depreciation point of view? I think the answer is self-explanatory, but let's just spell it out. What is better?
Yes, so I guess I'll speak about existing builds. So definitely they have their pros. So like I said, when you spend $2.8 million on a brand new home, one of the biggest thing that we find is that there is no real room for renovation or improvement. It's basically brand new. So one thing we find with existing properties is that owners have a bit more of a flexibility and more play, that they can actually redesign the home that they want to have available, and they actually have the capital to do so. So there's the ability to actually improve the property to a certain quality that they would want it to be, rather than selecting or having to go with what's already given to them. So the capabilities of renovations, I think, for existing properties are very lucrative at the moment as well, and the cost for them as well. So on the flip side, though, obviously in terms of depreciation, brand new properties, they have the ability to depreciate everything within a home. So when you're buying an existing property, you can only depreciate the building itself, the entitlement of the building's depreciation, and then also any improvements that the landlord or the owner is planning to conduct or has just conducted for the purpose to renovate. So one thing that we find is that if clients are to buy brand new homes straight from the developers or straight from the sales agents, they have eligibility to claim full depreciation on the fixtures and the fittings. And so this is something that the existing property owners can't claim on. So another thing is, especially with I guess apartment owners. So if people are looking at investing in apartments, is that apartments now, especially now, have quite an extensive list of strata assets or common areas. And the common areas are quite they're more, I guess, very much more updated than they were 20 years ago. So all those assets are also depreciable as well and entitled to depreciation. Yeah.
Even so, if they fall in line with the lot owner, or how does that connection work?
Yeah. So for say the whole plan, obviously they have the lot entitlement.
Yeah.
So the landlord basically will get entitled to an X amount of the barbecue area or the lifts. Yeah.
Yeah, there you go. Learn something new every day.
Yeah. So that is something completely separate. And obviously, if you buy an existing apartment, those depreciable assets would no longer be eligible for depreciation, because you can't renovate the
you can't
the car
yeah.
park. Yeah.
There you go. Perfect. Any final words? Any other tips? Anything else that you'd like to share?
Well, Anmol, I think especially when people are buying into existing properties or even brand new properties, it never hurts to have a quote provided. Most quantity surveys will generally give a estimate on what the guarantees would be on depreciation, and at least in that way, I think it helps property investors and landlords make the right informed decisions and forecast their plans with property investing, because property investing is not a short-term game. It's long hold. Yeah.
Absolutely. And we need a lot more supply of investment property. So, especially to service the new families that are coming into the country. If anyone is considering purchasing and making that property available, do get in touch with us. Happy to help throughout Sydney, rented properties throughout Sydney, and there is consistent demand everywhere for more property. So definitely a great time to buy for those that have the capacity and the serviceability of that, because returns from a residential property investment are far, are catching up to what a retail or a commercial asset is at times at different places. So it's definitely more attractive with the level of return. I mean, as I was saying, last week we rented out a property that we advertised at $390, and we had offers at 500 and more. And about 25 families missed out. So all these people are still actively looking out there. So we definitely need more investment properties to be able to meet the demand.
Yeah, I agree, Anmol.
Perfect. Well, thank you so much for your time. And for those of you that are watching, if there's any other questions that you'd like to discuss offline, do feel free to add any comments, like, share, and comment on the video so that we can reach more people. And if there's more questions to be asked, we can answer them. Thank you very much for watching. We'll see you guys next time.